Good morning, good morning, good morning to everyone. Another beautiful Saturday morning. Happy to be here. This is Coach Steele's Finance Training, and we're happy to have you here with Coach Steele's Finance Training. I am Coach Steele, the financial voice of the people. And here at Coach Steele's Finance Training, I need you to know that we are live on YouTube and we're live on Facebook. So, make sure that you subscribe to the YouTube channel and you're following me on Facebook as well. And when you subscribe to the YouTube channel, any videos that I put out throughout the week, you have access to them. You'll get notifications about those emails that I'm not emails, those videos and content that I put out on the YouTube channel constantly throughout the week. Every once in a while, I will go live or put information out on Facebook, but YouTube is where majority of the content goes. And here at Coach Steele's Finance Training, we love talking about financial literacy. We want to make the conversation of financial literacy and financial talks normal, just like blinking your eyes. And what we want you to do at Coach Steele's Finance Training is to level up your knowledge about financial literacy. And once you level it up, and you acquire that knowledge, then we want you to put it to practice. We wanted you to learn how to make this stuff applicable for you and your situation, then put it to practice. And once we put it to practice, then we know for a fact at that point, we will see the fruit of our labor. We will see that financial harvest. And that's what I desire for each and every family, is to be able to reach and reap that financial harvest from leveling up with Coach Steele's Finance Training. And so we bring awareness, and we want everyone to be in tune and understand what's going on out here in this financial system, in this financial world, so that everyone can benefit and so that everyone can grow. So definitely, once again, good morning to every person. I'm always live, 9 a.m. Eastern Standard Time Zone on YouTube and Facebook. So make sure you subscribe to the YouTube channel and follow on Facebook. Happy to have you here on this morning. And of course, today, ladies and gentlemen, we are talking about a few things. We'll touch on a little about the fact how the feds have lowered the rates and what that means for the average person. What does that mean for an investor? And so that's something that you can glean from us today as we tune in and try to find out what does that mean for us. Good morning to you, Yvette Steele, my beautiful wife. She's here tuning in. So thank you for your loving and consistent support. Also, we are going to briefly talk about those 40-year mortgages that they are consistently trying to let everyone know that they are offering as well, and the pros and the cons of the 40-year mortgage. And also we'll deal with a little bit of how to get out of debt. And so that subject matter is something that a lot of people are wondering about and trying to get guidance and help on. So definitely we'll deal with all of that today. The Fed's lowering the rates, 40-year mortgages, and how to get out of debt. So appreciate everybody from tuning in. As you tune in, as you dive into the channel, make sure you tell me good morning. Make sure you say hello. And also, if you're cleaning right now, that's fine. Throw me into the headphones, throw me in your Bluetooth, whatever it is, keep cleaning. If you're cooking breakfast, if you're making breakfast, if you're laying down in bed, whatever it is, just have me running. That way you can hear, and we're going to bless you with this content and bless you with this information. So continue to what you do while we listen. If you're driving, you're listening to some music, go ahead and put me in. So hopefully I provide more of an asset and quality to your day than that song you're getting ready to listen to. So definitely happy to have you here. And so when we talk about the subject of, last night was awesome. Everybody that tuned in last night, awesome time as let's see, good morning, Miss Graham. And so last night we had an awesome conversation where we were talking about planning for retirement and what it takes to plan for retirement, what it requires. And I had great interaction. I think we had at least 47 comments of interaction and about over almost 200 views on that video. Good morning, Mr. Castile, to you as well. So last night's conversation about planning for retirement was amazing. So if you missed that video, make sure you go to the YouTube channel and click on the live option, and you'll be able to go back and watch that YouTube live of last night's conversation about planning for retirement and doing the math. It was amazing, very eye-opening, and we had great interaction. And feel free to leave comments in there. I'll go back and look at them and address them as they come forward. Miss Patricia Ford, good morning to you as well. And so once again, just want to keep everybody in mind, we have gotten we're over 300 subscribers. We're around 324, that area. So we definitely hit the 300 mark. We gave away $85 and everyone has received their money from that giveaway. And when we get to 400, we're going to give away some more money. We're going to just keep growing this community and have these conversations about financial literacy. So today, when we talk about the Federal Reserves and these rates being increased today, let's deal with it a little, and the 40-year mortgages and how to get out of debt. Let's deal with all of that today. That should take no more than an hour, and we should be out your way. And once again, if you can't catch all of it, it's fine. I'll save it on the YouTube channel, so you can always go back and watch it as many times as you need, so that way it will sit and you can glean from it. All right. Now, Feds lowered the rates. And so some people are happy, some people are upset. And, I have a real estate friend, Mike Ferrier. And Mike Ferrier, his mindset, and we talk on Thursday evenings about financial literacy on Facebook. And his mindset, coming from the angle of a real estate agent, he wished they would leave the rates as they were, because from a real estate agent, let's see, Mr. Reggie's talking about the giveaway when I get to 400 subscribers. So from a real estate agent, his mindset was leave the rates as they are, don't lower them, because he's saying as a real estate agent, there are not many houses on the market. There's still a shortage of houses on the market. So even if you lower the rates, it doesn't change the supply. So if the demand is high, but the supply is low, then it is going to cause an increase in cost. And it's going to cause for more people to bid on houses and try to outbid each other, which is going to bump up the cost of living. So for him as a real estate agent, he didn't see a huge benefit in it and didn't really like it. But think about this. If you are a real estate owner, if you own property, if you're an investor, and people are bidding higher for these properties and the value of properties are going up, then as an investor who wants access to equity, you may like the fact that the Feds lowered the rates if it's going to cause for the value of properties to increase in value. So that, for an investor's point of view, they may like it for a number of reasons. Why? Because a real estate investor, as the value of properties increase and tenants are paying down the balance of a property, they have access to more equity. They have more access to more equity in the house. So basically, real estate investors can now pull out the equity of the house. In other words, pull out the money, which is the difference from the value of the house and what's owed on that property. If the house is valued at $200,000 and the balance is at $100,000, there's the difference of about $100,000 in that property. So there's the equity. A real estate investor can pull out a portion, a percentage of that equity, take it, and either A, put it in their pocket. It's a non-taxable event. And of course, the tenant is going to pay that loan back down as they pay rent, or that real estate investor, when they pull the equity out, can then go buy another property, another investment property, to create more passive income, or they can go put those funds in another asset to create more money. So from a real estate investor's point of view, they may like that this event is happening. And I'll tell you something else. Business owners, people who have commercial loans, or they just recently had a commercial loan in the past year or so, depending on what interest rate the interest rate was when they got that original loan. And if you're not an investor, this may be boring, so I'll definitely make it more practical to the average person in a few minutes. But far as dealing with the Federal Reserve, if you had a commercial loan recently, and let's say your interest rate on that commercial loan was at 9%, 8%, whatever it is, you're happy that these rates drop, because guess what that investor can do now? That person who has that business loan, that commercial loan, they can refinance it at a lower rate now. What does that mean for them? If they had a commercial loan and they were paying $1,000 a month for that loan, and now they can refinance it, and maybe their payment becomes $925, $950. There's a difference in between $75 to $50. So they could technically refinance and increase their profit margins on whatever they were financing or using that loan for. So for a number of reasons, people could be happy. For the average person who just recently bought a house, they might be happy. In the past year or two, they may have bought their home, their new house, or refinanced their mortgage at a higher interest rate. And now these rates are lower. So now that the rates are lower, many people are going to run to financial institutions to refinance their mortgage. They're going to refinance that 30-year mortgage. Some people may do a cash out, consolidate. Some people may just go run the refi to lower their monthly payment of that mortgage, which will work temporarily, because if your property taxes and insurance goes up, then that loan payment will probably go up anyway. So many people rush to refinance. What does that mean when we rush to refinance a mortgage? Well, it means financial institutions are going to become very wealthy. Well, not become very wealthy. A lot of them already are. But financial institutions are getting ready to make a lot of money off of a lot of people who are rushing to make an emotional decision because they're going to refinance their property. And so what does that mean? If you refinance that 30-year mortgage because you can get a lower rate, it makes people feel more comfortable because they're increasing their cash flow at the end of the month. So now instead of making a mortgage payment of $1,700 a month, now maybe they're only paying $1,625 a month. It gives them $75 worth of breathing room. But you're probably going to have to pay closing costs and other fees for that. So therefore, the banks are really going to get over right now because a lot of people will run to refinance. And so if you're going to run to refinance, you have to be strategic and know why you're doing it and what are the short-term and the long-term effects of rushing to go refinance. Rushing to go refinance isn't always the best answer, because you reset that amortized loan. And when you reset an amortized loan, you must remember the first about 10 years, 10 to 12 years, that amortized 30-year mortgage loan is front loaded with interest. And so a majority of your mortgage payment is going to go to the bank to pay the interest, and it's not actually going to go to the bank to pay down the balance of that loan. And so the principal, whenever you make your mortgage payment, you have the principal payment, you have the interest, the portion that goes to interest, and of course we have some of it that goes to escrow. But the part that goes to the principal is very, very small. Very minimal amount actually goes to the principal. So good morning to you as well, Anitra. And so as we're talking about potentially refinancing just because interest rates drop, it may not always be the best answer. Good morning to you, Mr. Darius Smith. I hope you're having a good morning and all is well for you. And hopefully you're having some success with your trading as well. And so when we look at this, I'll probably share my screen because I want you to understand the effects of a 30-year mortgage. I think, yeah, that's what I'll do. I'll quickly share with you all the effects of a 30-year mortgage so you can really understand what's going on when you have a 30-year mortgage and what it means to have an amortized loan. Good morning, Mrs. Hampton. Happy to have you online as well. And so, it actually would be a good idea Marilyn, to have your husband on here and talk about entrepreneurship too. I think he would do an amazing job and provide some insight on some things that people probably have never thought of before. So anyway, as I share my screen and we're talking about the effects of a 30-year mortgage and why you really have to know what you're doing if you're going to refinance a mortgage, and there may be a better option besides refinancing your mortgage. There may be a better option to be able to just pay that mortgage off. So you don't have to go through the motions of rushing to refinance to give the bank more closing costs and pay more fees and everything else when you could actually just pay your mortgage off in potentially 5 to 7 years. It's possible to take a 30-year mortgage and pay it off in 5 to 7 years. When you refinance that amortized loan, I'm going to share my screen. When you refinance that amortized loan, ladies and gentlemen, you are putting yourself in a tough spot. All right, let's see if I can, what I say, supersize this. I don't know if I can. I'll try to make it bigger for you to understand. Yeah, this is good. This is good. All right, let's see if I can make it a little bit bigger. There we go. So if you start with a 30-year mortgage, and let's say that mortgage is $250,000, and let's say the interest rate is 6%. So you have a 30-year mortgage, interest rate is 6%, and that should be pretty close. You might be able to see that one. And what you'll learn and understand is that mortgage payment, let's see if I can go to, I don't know if I can, that mortgage payment is $1,000. Let me see if I can slide this over. There we go. That mortgage payment is $1,498.90. I'm sorry, and 88 cents, right? So out of that total mortgage payment, that $1,498, 1,250 of it go to interest. In other words, it goes to the bank. It goes to the financial institution. The bank gets that money. And that's interesting. Out of that $1,498, when you make your mortgage payment on that house that costs $250,000, the bank gets a majority of that payment and puts it in their pocket. The principal payment, correct, Darius, you're paying majority into the interest and not on the principal. And a lot of people don't understand how lopsided it is. The principal portion is $248.88. Can you imagine owing somebody money? Let's say you owe them $1,000 and you go to pay them, let's say you give them $500. And so you're like, all right, when I give you this $500, now I'll only owe you about $500. And I'm halfway there. But you give them the $500 and they take $400 of it, they put it in their pocket and they apply $100 of that to the balance of the $1,000. And they say, all right, well, now you only owe me $900. That is what the banks do with an amortized 30-year loan. So $1,250 goes to the bank, $248 goes to your balance. And so that's why if somebody bought a house for $250,000, that first payment, as you see right here, it leaves the balance $249,751.12. So that's because the $248 went to the balance. That $1,250 went to the bank's pocket. And so accumulated interest paid by month, as you see, the bank just loads up on all of that money. You're basically making the bank extremely rich. And they do that for the first probably 12 years of that loan. I'm going to quit sharing the screen right there. But that's why a 30-year mortgage is very, very dangerous. 30-year mortgage is very dangerous. So you have to understand what you're signing up for, and you have to understand the consequences of it and the repercussions. In other words, 9 times out of 10, if you pay a 30-year mortgage for full term, you're going to probably end up paying for that house at least twice. And if halfway through that process you end up refinancing, hey, you might end up paying for the house more than twice in a sense. And Janet Simpson says, good morning, Simon Steele. Thank you for educating up financially. You're welcome. Definitely. I want everyone to learn this stuff, learn this information, because you have to know what you're signing up for. And once again, if you refinance a loan, make sure you know why you're doing it. And if there was a better option or a better route for you, there may be a better way. And so there's definitely better options and ways to handle this instead of rushing to refinance. There are programs and systems out there that will teach you how to pay your mortgage off in 5 to 7 years. So why carry a 30-year mortgage when it could be potentially gone in 5 to 7 years? Even I myself paid my mortgage off in 3 years and 7 months. And so you may be able to do it faster than 5 to 7 years. But if it took me 7 years, 8 years, that's better than 30 years because I saved thousands of dollars in interest that would have gone to the bank are now in my custody. And so let's see, Darius says, yeah, because you basically reset it. And if you did a cash out refinance, you're going to be paying an even bigger mortgage. That's exactly it. So whether you refinance the whole loan or whether you do a cash out refi, that money definitely isn't free. Some people do that to consolidate, but there's better options, better routes, better strategies besides doing the cash out refi to consolidate and things like that. And so we do that, and we teach people how to get out of debt, whether it's consumer debt and a mortgage, through using the HELOC strategy. And if that's something that you want further information on, just let me know and I'll send you some information about that program as well. So as we continue forward and we're talking about the Feds lowering the rates, yes, a lot of people are going to refinance and financial institutions are going to get rich. There are even financial institutions that are now doing 40-year mortgages. Think about this. If a 30-year mortgage is getting thousands of dollars on an amortized loan, then what do you think a 40-year mortgage is getting? That means, just like I gave you all the example of how a bank is going to make thousands of dollars on a 30-year loan because a majority of your mortgage payment goes to the bank pocket, and they take a tiny bit of your payment and put it towards the actual principal. In that example we saw $1,250 go to the bank and about $200 and something go to the actual principal on that $250,000 mortgage. So what's the way you can pay off your mortgage and pay it off faster? If you have a 30-year mortgage, Darius, and you need some information, I'll definitely send you some information on using the HELOC strategy to pay off your mortgage faster. So I'll definitely get that information over to you. And I'll write that down as a note real quick. But yes, and some people will use a simple way to pay off their mortgage, which is make an extra payment. But it's effective. It's better than nothing, but it's not the best route to pay off a 30-year mortgage. Yes. And so the banks, these financial institutions, like Yvette Steele said, they are trying to keep us in the rat race. And we can make a decision not to be in this rat race that takes up your money. And a lot of people are saying, it's so funny because people will do the math and they'll play the numbers game with you. But I've been in this game for a while, so I understand pros and cons on all sides of this. Some people will say, well, wait a minute. I don't want to pay my mortgage off because the tax write-offs that come with having a mortgage. Let me get some water on that. They don't want to pay the mortgage off because there's tax write-offs if they have a mortgage payment. They get to write off the interest, of course. A certain portion of the interest they can potentially write off on their taxes. Now let's do the math on this. And it doesn't take long. I got a calculator, so you don't even need a calculator. And so when it comes to this, think about this. Some people are saying, I don't want to rush to pay off my mortgage because I get to write off a portion of the interest that I paid on this 30-year loan. So let's say the interest for the year you paid on your loan was, I don't know, $5,000, $10,000. Let's say you paid $5,000 or $10,000 on the interest on your loan. Good morning to everyone who's just tuning in. We're talking about the Federal Reserve lowering the rates, and we're also talking about strategically how to get out of debt, how to pay things off. We're talking about financial literacy And so we're having a great conversation. If you are not following me on Facebook, make sure you hit follow. If you're not subscribing on YouTube, make sure you subscribe. We're talking all things financial literacy, and always go back and reference and research what I'm saying. That way you can prove and find out for yourself whether or not what I'm saying is factual. So, ladies and gentlemen, as we continue on, if you're tuning in, make sure you share this, whether you're on Facebook or YouTube. Make sure you share this for other people to listen to as well. And anyone who knows me, you know what's near and dear to me. I don't like the statistics that say women are least likely prepared financially from month to month for retirement and all of that. So if you have female friends, make sure you tune in, because we're going to change those stats. We're going to do something about it. We're not just going to talk about it. We're going to share the knowledge and do something about it. So once again, if you get $5,000, you pay $5,000 in interest on your house, or let's say you're paying $10,000 in interest on your property. What if your mortgage payment is $1,500 a month? What if your mortgage payment is $1,500 a month? You'll keep paying $1,500 a month for 12 months just so you can write off $5,000 of interest? 1,500, 1,500 times 12 is $18,000. You would rather keep paying a bank $18,000 and so you can just write off $5,000 or write off $10,000? The math's not mathing. So it makes sense to go ahead and get rid of that mortgage, because then guess what? Now you don't have that interest and you no longer have that mortgage payment, but you just freed up and have more cash flow now. Now you got extra $1,500 a month to use for whatever you need to. Some people feel like they don't have enough money for life insurance. They feel like they don't have enough money for this, that, and the other. Well, if you eliminate debt strategically, you'll have plenty of cash flow. You have plenty of money to invest and put different things in place that you desperately need. So it's all about budgeting and managing your money properly. But once again, there are creative ways to get out of debt. Don't limit yourself just to the knowledge that you have and only the information you have. Be willing to open your mind up and listen to new ideas and new ways of doing things. Otherwise, you get caught up in the rat race, you get caught up in the trap, and you get caught up in what the system wants you to do. And then now you're paying the bank tons of money. And why do you think they keep building more banks? They keep building more banks because we keep giving them more money. Well, I can't say we. Well, we as a people give them more money. But what I do with Coach Steele's finance training, I find creative ways to put more money back into my pocket so that I can put more money back into my community, to my loved ones and people that do need help and assistance and guidance, and most importantly, so that I can manage and maintain my family better. The Feds lowered the rates. Yes, people are going to rush to refinance. But why rush to refinance without a strategy and without a plan? And you reset that 30-year mortgage, and now the bank makes even more money off of you. So it's not always the best route. There's other opportunities and other routes out there. And I want to show you the difference, because now they're trying to convince people to do 40-year mortgages. And I want everyone, if at possible, to stay away from a 40-year mortgage. It doesn't make sense. And they're going to convince you, well, they're going to attempt to convince you to do a 40-year mortgage because it will be a lower payment. That's what they'll try to tell you. Let's see if I can share the screen of a 40-year mortgage. Let's see what this one is. Let's see. I think my mouse is acting up. Okay. All right, this is a 30-year mortgage. So when we look at the same value, like we used example earlier, that $250,000, when we had $250,000 house at 6%, as we scroll down, we'll see that that monthly payment was $1,823. And that's on a 30-year mortgage. And I want you all to see the difference with the 40-year mortgage. And so now, with that being the 30-year mortgage, if we scroll up here, we'll see that first year. Let's see if I can get the mouse on it. That first year, 2024, the interest payment for that year is going to be $14,916.49. The principal payment It's only $3,070.03. You have to be able to see this as highway robbery. You have to be able to see that this doesn't make sense. Like Assyria said, the math is not mathing. This doesn't add up. So now my balance on my $250,000 mortgage that I originally got is now $246,929.97. So when you first buy a house, most of the payments, most of that money, most of this $17,986.52 went to the bank. The bank got rich every time. So that's why you have to be careful before you make the next move. Boom, 2025. Look at that. Bank still winning another 14 plus. Oh, yeah. 14 plus 2024, 14 plus 2025. That's at least 29,000 to their good. Meanwhile, we only got about 6,000 and some change going to us, about a little over 6,000. And the cycle continues. Oh, it doesn't stop. They do this for the first about 12 years of the mortgage. And this is why I'm preaching and teaching and showing people how to get out of debt, because there's a way to recapture that and not give that bank that interest. You don't have to give the bank this interest. So if I'm teaching people how to pay off their mortgage in 5 to 7 years, think about if we keep going year after year after year, how much money the banks are getting, right? Well, this said it started in 2024. When we get to 2030, the average client is paying off their mortgage in 5 to 7 years. Guess what? At this point, the bleeding might stop. So all these other interest, all of the interest that people are going to continue to pay, a lot of clients are now no longer paying that because they paid the mortgage off. So now they have saved money and interest, and they have increased their cash flow. And now they can invest like crazy in whatever it is, in whatever asset class, whether it's real estate, whether they want to get into what some people call infinite banking concepts, if some people want to increase their insurance, if whatever it is, your goals, your personal goals are. I'm going to quit sharing the screen here, but that's a 30-year mortgage. 30-year mortgage. That was a 30-year mortgage where that mortgage payment was, let's see if I can get back to it. I believe it was around 1,800 and some change. Let's see. Y'all bear with me. I might have hit the wrong button. Let's see. Am I still live? Okay, I thought we're still good. We're still good. All right, let's see. Good question, Darius. Can you use the HELOC strategy if your house doesn't have any equity? So there's another option that we do with clients if they don't have any equity in their house, Darius. So I'll send you some information on that as well. So definitely a good question, because a lot of people feel like, well, I don't have enough equity in my house, so I can't use this strategy to pay my mortgage off in 5 to 7 years. And so I thought that as well initially. And so it ended up taking me longer to get started when I could have had my mortgage paid off even faster than the 3.7 years. So definitely good question there. And we help clients even if they don't have equity. Every situation is different, and usually it goes off of your personal situation. We look at what people have coming in, what they have going out. Some people live in paycheck to paycheck, so they think the system won't work for them, but they don't realize it might be paycheck to paycheck because they have tons of debt that's eating up their cash flow. But when you're able to strategically consolidate the debt, it frees up cash flow, and now you have something to work with. He has equity in his house. He was just wondering, do you have to pay more towards the house? If so, by how much? Everybody's situation is different, Darius. So it's not always about paying a specific or a certain amount towards the house. Because if that's the case, then that would weed out tons of people from being able to get out of debt. So let's see here. I wanted to show you that was the 30-year mortgage. Let me take my time here and see if I can click on this stuff properly. All right. So that 30-year mortgage, as we saw the craziness with it, we saw the numbers were not beneficial towards us. And let's see if I can get this. And the monthly payment was $1,823 on that $250,000 mortgage. Now, when we look at, let's see, let's go to a 40-year mortgage. And this is why I want to tell everyone to stay away from a 40-year mortgage. Let's see. That might be it. Nope, that's the 30-year. Screen. All right, hopefully I picked the right one this time. All right, so I believe this is the 40-year right here. All right. So a 40-year mortgage, this is the right one. I just need the screen to get a little bit bigger. Yes, Assyria, they are doing 40-year mortgages. And I actually helped a client yesterday who had a 40-year mortgage. My goodness. So we have the same $250,000 loan at 6%. And this time, instead of 30-year mortgage, a 30-year loan, it is 40-year loan term. So I'll show you that. And now we saw the 30-year payment was $1,823 a month. Now this 40-year, this is where they entice people. This is where they reel them on in. It's because they say, well, look, we can get you a lower payment. So now you're only paying $1,700 a month instead of $1,800. So now you can save $100. Well, that's what they tell you. You're saving $100 a month on your payment. And for the year, because it's 12 months in a year, you save an extra $1,200. You have an extra $1,200 of cash flow in the year because you don't have to make it on there. That frees your money up to be able to take care of other things. Meanwhile, back at the ranch, I'm not going to tell you how to type that in the chat, but if you want to type meanwhile back at the ranch in the chat, you can. Anybody who goes back and look at this or read the comments, they're like, what in the world? All right, let's see if I can get over here. Let's see. See if I can. Oh, I need to view loan breakdown. Wow, this one won't even show up. I can't even show it. I want to, but I can't even get it to show up properly. But I wanted to be able to show you the craziness. I knew Assyria was going to write it on in. See, you just took the bait. But anyway, let's see. I'll just put it down here. You can see the total interest paid. Total interest paid $410,000, $410,256.37 on this house that you were trying to buy for $250,000. This is ridiculous. And most people won't even make it a full 30 years of paying their loan. They end up refinancing during that time frame. And also, not to mention, many people move every 7 to 10 years. And so when you move, and not that it's a bad thing, it's good to move sometimes, better opportunities. When you're moving, after you've been in that property for 7 to 10 years, the bank, that's when they're able to get the most money from you. So they capitalized big time. They took a lot of money in interest. Then you move just to go pay another bank a lot of money in interest. So anyway, that's a whole nother subject. I'm not telling people not to move. If better opportunities present itself, do what you need to do. But what I'm saying is, if it's possible to pay off your house in 5 to 7 years, when you get ready to move, you might have already had that house paid off in that time frame if you learn to do things differently. Then when you move to the next house, instead of selling that house that you just paid off, you can rent it out, and the rent money, the profits, will help you pay for the next house you move into. So that's $410,256 paying rent on that property for 40 years. I wonder if I can see the difference I got too many screens pulled up. I wonder if I can see the difference on the 30-year mortgage. That's 40. Go back out. Y'all bear with me in my lack of technical skills here. Okay, I think this is the 30-year. I just want to see the total. Yep. Total interest paid on the 30-year, $289,595.47. Now, you see the difference between the 40 and the 30. So no one should be wondering why I'm saying do not do it. Stay away from those 40-year mortgages. So you definitely understand why I'm saying that. It's important, it's vital, and we have to put this information out. Some people just don't know. And because they don't know, someone will try to capitalize and take advantage of people who don't know any better. All right, let's see here. Okay, so where are we at? I'll tell you where we are. We are talking about paying 30-year mortgages, 40-year mortgages, refinancing, going through these motions in this system that the financial world is telling us that is normal for us to do. And we're trying to grasp and understand what are the consequences and repercussions for it, and does it make sense? And so we have to understand the math behind it. Now, that same person that bought a $250,000 house at 6%, doesn't matter if it's at 5%, whatever it is, that same person that bought that house for that price, we want to look at, yeah, it is yikes. That person who bought the house at $250,000 for 40 years, the interest was over $400,000. Man, how many times did they pay for that house? Just do the math. That was just the interest. That's not the principal. So why am I talking to you about it? Because there are ways, other creative ways. Here we go with another screen share. Let's deal with this John Doe. If I can get this screen back correctly. Oh, Lord, I don't know if I can. Let's see. No, that's not it. I may not be able to give you the example that I want to give. Let's see. I know what I'll do. I'll quit sharing and I'll fix it. And then once I fix it, then I'll go back to that screen. How about that? So I want to show you an example of someone who can be in that situation and end up being able to pay off a 30-year mortgage in 5 to 7 years potentially on a $250,000 mortgage. That's the example that I want to use and give you. And we're going to get to it. It's just taking a little longer. All right, let's see here. And of course, I appreciate everyone as you are tuning in. Make sure you subscribe on YouTube and make sure you follow me on Facebook as we're putting out this valuable information and content. There we go. I'm back in business. I just need to enlarge this page and then I'll share the screen with you. There we go. All right, we are ready to rock and roll. Screen share. There we go. All right, so anyway, now we're back in business. We've been talking about someone who bought a property for $250,000. We saw the 40 years example. We saw a $250,000 example. I know you want to see an example, Darius. It will probably take longer than the time that I have here to be able to show you, but we can do the math real quick. $250,000 mortgage at 6% interest, and it's a 30-year mortgage. There goes that interest only. I'm sorry, the principal and interest payment. We saw that, and we saw how it was broken down. 1,200 plus went to the interest. About 200 and something went towards the principal. That's that same P&I. All of that calculated. And what I did here, I just used an example. Let's say it's a single person, and let's say their net monthly income is $6,000. Their personal expenses are $2,506, plus we're already calculating also their P&I as well, their mortgage payment. So when you add up all those expenses, it's more. The 2506 plus the mortgage payment. And let's say they do the HELOC strategy. There's different ways to do this strategy, first lien, second liens, and all of that. But even conservatively putting these basic numbers in as if this person's income doesn't change, doing this in a conservative way, we see that this person has 8.8-year payoff projection on their mortgage. This far destroys that 30-year mortgage or that 40-year mortgage. This person knocks it out in 8.8 years, and combined interest, they save $219,000 in total interest. Now, when I ran this system, I paid it off in 3 years and 7 months. That's not everybody's story. There are some people I've seen they've done the system and did it in 1 year. But the average person is anywhere between 5 to 7 years. And in this scenario, this person knocks it out in 8.8 years. And so that's through running this system. And you just, like I said, you have to understand what you're dealing with when it comes to a 30-year mortgage. Let's see. And it's all about learning how to use your money more wisely. It's all about learning how to take what you have and strategically use it to your advantage, because the banks are taking our money and using it to their advantage. Now, can you learn this system in 2 seconds? Can you learn it in 1 day? Probably not. And so that's why we provide mentorship and we provide guidance. Everyone doesn't want to pay their mortgage off faster, Darius. Some people want to give the bank the $400,000 or the $250,000. I wanted to pay my mortgage off faster. I was okay with paying my mortgage off in 3.5 years, 3 years, 7 months, because it gave me relief. It gave me freedom. It gave me peace of mind. I wanted to have my debt paid off, and my cash flow is freed up, and I can invest like crazy and do other things. Some people don't want to pay off their mortgage fast. They'll do the math and say, but if I take that money and I invested in this, that, and other for 30 years, then I can take the money that I invested and then slowly pay off my mortgage and pay off my mortgage that way with the money that I made and the profits. So some people take that approach, but then you're saying, without a shadow of a doubt, you're confident that the job is going to keep you on that job for 20 or 30 years for you to build up that cash flow of money. And I deal with clients every day, guys. And the thing about it is, I've seen so many people that thought they were going to be at a job 20, 30 years. They get laid off. They lose their job. They were doing well for 8 years. This happened, that happened. And now all of a sudden they're in a difficult situation. They're about to lose their house. All of these scenarios happen because we think that they're smooth sailing all the way from start to finish. Well, I like to play the safer route of, I would rather pay this debt off, no longer have this mortgage debt, and be comfortable than to play a 30-year game of how much can I save to pay off that mortgage later on. I don't want to go into retirement with a 30-year mortgage over my head. We can look at the stats. We can look at the math, and we see what happens with a lot of people. They are not financially prepared for retirement. Debt is plaguing America. Debt is taking over and plaguing individuals, and people are struggling financially. So to get out of debt frees up your cash flow so that you can save strategically how we need to. And so, no, I'm saying, why would using a HELOC pay it off faster? Once again, using a HELOC to pay it off faster, like I said, there's no way you're going to learn or understand that system in a few minutes. And so you have to learn the power and the movement of your cash flow, be willing to get mentorship, be willing to get guidance. Like, think about this, Darius. You do a lot of day trading, or you do trading, and you're not going to be able to explain trading to someone in 2 minutes or 5 minutes. They would need to get mentorship, guidance, and have understanding, learn how to read charts and all that good stuff. But if you're willing to adjust your mindset, then of course you can learn that stuff. And that's what I enjoy doing, is teaching people how to improve their financial situation and how to get out of debt. And today we learned and got to see that, hey, you know what? There are better options. There are better ways. The banks want us to refinance. They want us to go back so they can get those closing costs and all that good stuff because, yay, they lowered the rates. But you have to know what that means for you and how to take advantage of it. And so if you're a real estate investor, or let's say you're building homes, you're happy about this because you can borrow money, you can get a loan to create a business opportunity, to create cash flow at a lower price. You can borrow the money at a lower price now than you could a couple months ago. So that's something that people are going to be happy about. And like I told you all today, I was going to talk about 40-year mortgages and why to stay away from them. Now, if you're about to lose your home for whatever reason and you have to, if there's like a financial emergency and you have to adjust to a 40-year mortgage to create more cash flow, then I guess that might be a reason to do it. But I would rather you come see me and learn a better system that might be able to help you out before you hit the panic button and give the bank all of that money for 40 years. That's a waste of money. That, think about this, that one example of 40-year mortgage and that 30-year mortgage, one was given over $200,000 to the bank, the other one was given over $400,000 to the bank. What if you didn't pay the bank for 30 or 40 years and you could put that money back in your pocket? What would your retirement account look like then? Because they say most people aren't prepared for retirement. That's because we gave our retirement to the financial institutions. But if we can flip this thing and reverse it, well, if you flip something and then you reverse it, it might be back the same. Anyway, if we can reverse this thing, we can put the money back in our pockets and we can save ourselves a lot of money. We're getting close to, I've been on for about 56 minutes and 18 seconds, and I don't want to go over an hour. So I know I'm going to cut this thing off in about 2 or 3 minutes, but I definitely appreciate everyone for tuning in so that we can have a conversation about what these the Federal Reserve lowering these rates, what it means. And another thing, and this kind of leans towards what Darius does, they look at history and they say, when the rates are lower, does that mean the market is going to go up, or does it mean the market is going to go down? Well, they've had times where the Feds lowered the rates and the markets went up and down. So they can't quite put their finger on what the market is going to do. Appreciate everybody for tuning in. Don't know if you have any thoughts, questions, concerns, anything like that. Please feel free to throw them in the chat, and always connect with me one-on-one if you need to. If you want information about how to pay off your mortgage at an accelerated rate, let me know. I'll see the information. The same thing that I did and have success with, the same thing thousands of other people are doing and having success with, you can too. And of course, why didn't a lot of people know about it? Why would the banks tell you how to save from giving them $400,000, $200,000? It would mess up their billion-dollar business. So no, the banks aren't going to run around and tell you how to not give them as much money as before. And so this is Coach Steele's Finance Training, and I am Coach Steele, the financial voice of the people. And I love the fact that we have people tuning in. I love the fact that we have interaction. Most importantly, I hate the statistics on women in America and the financial situation of women in America and minority women. And it's funny because Syria, who's tuning in, she deals with the statistics of what's going on with minority women in the medical field and childbirth and things like that in America, and it's not good. And so I have my thing that I don't like, which is the statistics on minority women in America financially. They're least likely prepared for retirement. They're least likely prepared month to month to maintain themselves financially. And I believe getting the right education and information will help with solving that problem. But overall, I want everyone to improve their financial situation. I don't care what color, what creed, what nationality you are. We need to spread the message. That way people can improve their situations overall. This is Coach Steele's Finance Training. Once again, share this information, subscribe to the YouTube channel, Coach Steele's Finance Training. Make sure you follow me on Facebook. And throughout the week, I do post information on YouTube that may not go on Facebook. We did, in my last 40 seconds, we did give $85 away. I think it was last week or two Saturdays ago. Can't remember. Might have been last Saturday. And we did give that money away because the YouTube subscribers. We hit 300, and now we're on our way going to 400. When we get to the $400 subscribers, I'm going to do another financial giveaway. So all my loyal people, stay tuned and get paid. Other than that, be blessed and have an amazing Saturday. I appreciate everyone for tuning in and being patient with me.